I'm Adam Harder, Chief Investment Strategist for the Financial Enhancement Group. Thanks for joining us for this week's Market Carver, where we're first going to talk about the Fed's favored inflation metric, that's PCE. That's PCE inflation. 1.3% year over year is the most recent number we've got. This is important because the Fed's target is 2%, and they want to have confidence, their words, confidence, that we're working our way towards that 2% goal. So at 1.3, it's certainly just right where it had been, and it's not even close to 2% and not working its way there. So if anything, this is certainly telling us that the Fed, when they meet next month at the very important September meeting, if anything, it's given them reason to be patient and not hike rates. In our opinion, they're looking for anything, grasping for straws, finding reasons not to actually go forward and hike rates in September. This certainly gives them cover to not do that. Next, we're going to talk about the credit markets. We bring our clients together twice a year where we break bread and talk about what's going on in the markets. This past spring, we spent a lot of time talking about credit markets. I know it sounds like a really boring topic, and for most people it is. Not for us, but what we were talking about is really concerns for the amount of debt that had been issued by less than favorable borrowers. And we would begin to get concerned if we saw interest rates on those risky bonds start to work their way north. And that's what we're starting to see here recently in crossing an important metric last week. Most specifically, what we're talking about here, the difference between the interest rates on very risky bonds versus the interest rates on very safe bonds. And that has crossed 3% after being below it for quite some time. So this is another yellow indicator, yellow light indicator, something that we will keep our eye on, but it's not something we're really looking for. And really, we're thankful that we have been reducing our exposure for quite some time to these types of bonds. But we will certainly be staying tuned to that one. And lastly, on a more positive note, auto sales are still tracking to reach 17 million this year for the first time, as this very important segment of our economy continues to get healthy. Just for some context, back in the last recession, we had fallen all the way down to 12 million or maybe below at one point in annual sales. So working our way to 17 million is a very good indicator, and there's lots of reasons to believe that this will continue, even if not increasing, staying at 17 million, which would be a much healthier rate. So even if the rest of the economy is kind of sluggish, we have slanted our portfolios to benefit from these rising auto sales, and hopefully that will at least stay there, if not continue. So, hey, thanks again for joining us. You'll have 3 opportunities to catch our radio show. Why Low on Thursday afternoons from 4 to 5 p.m. That's on 1570 a.m. Saturday on QME, that's the 98.7 on the dial, 9 to 10 a.m. Or Shine 99 on Sunday from 10 to 11 a.m. Hey, thanks again and have a great weekend.